Good afternoon, everyone. My name is Konstantin Korologos, and I'm a clinical assistant professor with NYU Shack Real Estate Institute. We just had a meeting the other day, and we were going through some of the longevity of some of the people in School of Professional Studies, and my name came up on a list for 30 years at NYU, which was kind of, even though I knew it, it kind of still took me back. So I've had the pleasure for 30 years, most of which while I was working and teaching as an adjunct, and then the last 3 years working full time at NYU. And it's always great to be able to talk about what's going on, like not from a theoretical perspective, but from market participants on the ground, deals that are happening, trends that are showing up, and then recognizing when we have uncertainty and we may not necessarily know yet where things are going to be. So earlier in the semester, when I picked the topic, I said, office market, I always felt like because of the length of the leases, maybe we haven't fully seen everything materialize yet. And I had reached out to Doug to ask him if he would join me on this. We know each other from the industry for a long time, despite both of our youthful looks. We've actually been in the industry for a while, and I couldn't think of a better person to join me to talk about the office market and stress. So with that, I will try to get my computer to do what I'm telling it to do. I will introduce allow Doug to introduce himself quickly, and then we will talk about some of the items that are on the agenda. Please, if you have questions, send them in the chat, and I'll try to do two things at the same time and keep my eye on the chat questions. And hopefully we can, if not during, at least at the end, be able to respond to everyone's questions. So, Doug, let me let you tell everyone about you.
Yeah, perfect. Thanks. So again, I'm Doug Larson, and I work at Newmark, and I run the the national office valuation practice and advisory practice here. And Newmark has about 600 employees or appraisers around in over 60 offices around the country. My focus has been in primarily in New York City office building valuations, where we do a majority of our work for lenders and transactions, sales, financings. You kind of name it. Wherever there's a valuation needed, we're either working on it or close to it, or to understand what the transaction. So, and I've been doing this valuations my entire career, and working in New York City for nearly 30 years on office building appraisals. So I've seen quite a few cycles. This cycle is a little interesting because it's much different than the correction 9/11, much different than the financial crisis that we saw, and it's not quite as deep in terms of where rents have dropped, and the inflection points, and how we're recovering, but it's hitting personally, and it's the first time I've ever seen, and I never would expect this, that to have employees, not in their desks, right? Because collaboration is very, very important, to all companies. But thank God for Zoom and all of this technology that we're able to utilize, and I think it's going to be interesting how we're coming out of this, and how we're going to be, and what the recovery is looking like. So I can address that. I think I spoke earlier about, or just a minute ago, about where rents are now and where rents were in the prior two recoveries or recessions. And, 9/11 and the financial crisis saw about a 25% net effective rent decline. Now, during 2020 and 21, we saw about a 10% drop in net effective rents. So it wasn't quite as deep. And we're recovering much differently than we ever have in the past. And I'll go into flight to quality, the differences between Class A and Class B, and how those markets are recovering. But literally, we saw around the country, we've seen rents a vacancy increase. We're about 16% in around most of the national office markets, gateway cities, and other areas. In New York, we're about 18%, and what's shot up is, and that's availability rate. So it includes space that is expected to come online. So we've seen the markets and I'll go into some of the gateway cities, et cetera, but the markets in San Francisco, the Sunbelt regions, are doing pretty well. There a lot of people had moved out of New York. Now they're back, and we've seen an increase in residential rents and condo prices as a result. And coming back to the office is very interesting. So, but I think one of the things I'm going to talk about is what kind of trends we're seeing, in the office markets in terms of leases and accommodations. So the sublease space shot up to about 25 million square feet. It was probably around 12 million square feet pre-pandemic, and that's had an increase in the vacancy in New York. Sublease space has been dropping. We've just decreased about 2 million square feet as tenants realize they need to be look for space. Starting in the last 6 months of 2021, most buildings have seen increases in tenants looking for space. And brokers are telling, their clients and companies, you better start looking for space and you better start signing leases because rents are going up as people are returning and companies are returning. So, right now, we're still higher than COVID in terms of sublease and space, but we have about 24 million square feet of tenants that are in the market that are looking for space. The demand has been increasing, and it's actually higher than what it was pre-COVID. So tenants are worried about missing out on the best space, and we've seen more and more tenants that are signing leases, and that goes for New York, but also around the country. And it's a flight to quality to the best buildings. And the primary reason is because the companies want to make sure that their clients and staffing, when they return and as they return, are comfortable in the market and in terms of returning to work, and in that they have clean air, HVAC systems, et cetera. Amenities and terraces and all the bells and whistles that companies and building owners provide become more important, and those buildings are actually doing better, rather than the Class B market, which I'll talk about in a second. But most buildings have amenity space now, so bike rooms. They offer basketball courts, like in the Seagram's building, where they're renovating that property. And that has added a lot of impact on the office market. For Class A buildings, rents are basically back to where they were pre-pandemic, and even higher because of the flight to quality and the demand. So currently, Class B buildings that are not renovated, et cetera, that's really where most of the concern is. Those rents are still 10% below where they were in the market, and in terms of their rents, and it's been impacting the values of those assets. So a lot of that has to do with the major companies not being back, and tenants that are leasing space in Class B buildings are really the service providers for the major corporations who are basically 50% returned.
Yeah.
So
I was so surprised. I used to work at the Seagram's building. I worked at the Seagram's building in 2006, 2007, leading into the right before the financial crisis. And I don't remember any basketball courts. So
no,
that's expensive real estate on Park Avenue. So
it's very expensive, and just going into Park Avenue and some of the buildings that we've seen, we're seeing new construction going on. Obviously, One Vanderbilt, that has all the bells and whistles, has been the most successful building leasing during the entire pandemic.
Yeah.
Other buildings like Lever House, these iconic buildings like Silver Seagram's, 245 Park. These buildings are doing exceptionally well with the leasing because they're the better buildings and they are in strong locations. And the Plaza District actually is doing the best out of many of the submarkets. So if you look at, transportation, et cetera, Grand Central has been the strongest submarket, and primarily because of the transportation, because of subway ridership, and people weren't riding subways to work. But basically, it's the key to leasing space is to have a modernized building or a new construction and its location. So obviously the Plaza District is doing well. The Grand Central has done well. The buildings like One Vanderbilt have leased 350,000 square feet during the pandemic. And those rents are, over $200 a foot. So buildings like 425 Park, which is new construction, has done extremely well. Citadel is a major anchor in the building and has leased over, rent on the top floor at $300 a foot. They're now fully leased, with Citadel taking the balance of the space. So there's a lot of things that are happening as tenants are returning and gearing up for that, increasing their, needs for more space.
Doug, when you mentioned, Grand Central, coming into Penn Station, that's a little bit more of a ride. And I know that the East Side access is supposed to, at some point, hopefully before I'm using a walker and drooling on myself, that the East Side access is open and available for commuters coming in from Long Island. But it's interesting on how some of the submarkets that had been improving and where certain areas were the less favored child in the Manhattan market are maybe reversing a little bit, and you're seeing that demand back in the Plaza District, where Midtown South was really getting such a significant amount of demand kind of before the pandemic. I think that was like the cooler place to have your office space. So things always change. That's one thing you're going to always see in New York City.
Things always change, and but just jumping into Penn Station, and they've been renovating that property. It opened up during the pandemic last year, and Vornado is the guerrilla landlord over there. They, have gotten approvals from the city and now have plans and or will be starting the development of the Pennsylvania Hotel. We work very closely with them. So 2 Penn is being reskinned and redeveloped and doing very well with the leasing on that. So Penn Station is, in that district is not always achieved the highest rents, but the redevelopment of those major buildings is also going to, increase the flight to quality and the leasing and increase rents there. So it's very positive. That's, the things that we're seeing in that sub-district too.
And the connection that it's almost touching Hudson Yard. Like we haven't quite finished that full connection from 8th to the water, but it's getting there. And I think that connection, once that's complete, where it's viewed as one flow of a market, I think that probably will also benefit both ends of that strip.
Yeah, absolutely. Now you have, anchor tenants over there, technology. There's a connectivity that was always planned for Vornado. They've been very patient with their development in Penn Station area. And now you have Related and you have, Vornado and major developers like Brookfield and Manhattan West. That's all interconnected. All the projects are now open, and it's creating value in those properties. What's been really interesting, pre-pandemic, we saw this. The flight to quality was there, and those buildings, which we've probably worked on all of them or most of them in Manhattan and the far west side on the new construction, they were leased before they finished construction. So, and that drove leasing to be over 50 to 52 million square feet in 2018 and 2019. So that flight to quality still exists, and it's driven rents to north of $100, $150 a foot, and created tremendous opportunities for tenants and companies to rebrand themselves.
Yeah. As we look at where those costs have, where those rent levels have gone, I'm gonna kind of pull up a little bit, go a little higher, and look a little more broadly about kind of where the rates are, and obviously every time a new CPI number comes up lately, it's higher than the one before. And just I'll quickly walk through some of the data that I have. The slide deck will be available. I don't want to talk about the numbers in detail, but just to give you an idea of kind of where the market's been. I had this from a presentation last year that I'm just getting over COVID last week and staying in. It just kind of reminded me of a slide I used last year. Quarantine made me realize why my dogs get so excited about something moving outside, and just going for walks and car rides. I just barked at a squirrel. So this week reminded me of what it's like to be in again and not go out. So I'm looking forward to getting out again, which is hopefully what everyone who's not quite back in the office starts to do. Look, Treasury rates, we've seen the rates go up, and we've been hearing about CPI. This looks back, since 2000, and the blue line is the 10-year, and the red line is CPI. And obviously, kind of since 2020, and as a result, kind of post-pandemic, we could see the spike in the inflation number, and that has yet to fully play out as to how long it's going to be an effect, and how long it's going to affect consumer spending, as well as real estate, as well as rents, energy costs. And we have a little, tick up in the treasury. So with rates going up, that cheap money is ultimately going to work its way through the system. So these, again, are just things to be, to be mindful of. On the NCREIF side, which is private institutional real estate, this chart looks at the fourth quarter 2021. And since we're talking about office, the thing that I would just point out, out of the NCREIF index, which again, institutional pension fund, insurance companies, the portfolio, the index has 1,700 office properties with an average history of about 44 years and a $251 billion market cap. And the last several quarters, we've seen positive total returns. We had a little bit in 2020 of a decrease on value because of that uncertainty, but it's come right back. And this is the snapshot of private real estate money. On the publicly traded side, NAREIT, the first column is office returns. And as of 2021, we had a 22% increase in returns for the NAREIT office component. Year before, 2020, negative 18%. So we saw that quick recovery back. And then the slide, the chart to the right has year to date 2022. So again, for office, we're seeing in March 5.6% increase, and a year to date 2.78%. So the REITs have continued to show some positive momentum in terms of valuation. There's a lot of capital that's been raised. The blue line represents the aggregate amount of capital per quarter. So obviously the 2022 doesn't have a high number because it's the most recent, not a full quarter, but the number of funds. And then we see the amount of money that's being raised for the real estate sector. And when you take another look at it in terms of dry powder, there's a lot of capital that's there waiting to be deployed in these various real estate strategies, from core and opportunistic to real estate debt. So there's a lot of money. Capital on the equity side, capital on the debt side means that there's liquidity to help create transactions. So hopefully, at least we have some good tailwinds from a capital perspective to allow for the transaction market to keep moving. So on that, maybe I'll go back to the questions that we were looking at initially. Oops, not that far. So maybe Doug, on the work from home, one of the reports I always enjoy reading of yours is when you look at the key fob swipes, people going into the buildings. And that's kind of a pretty good indicator of the percentage of people showing up in the office. And we saw a dip toward the end of last year. I don't know if it was just the holidays, where people said, hey, you know what, I don't need to go in December. There's still a little bit of a bug going around there. I'll wait and see what happens in the coming year. So.
Yeah. So, right now we're about, it's a little bit under 40% in terms of, people coming back to the office, and it's about 3 days a week. A lot of companies have exchange programs and told their employees to come back, but it's also very driven by keeping employees happy, because it's a very competitive market. So the most flexible industry has been technology, while financial services have been more demanding about their tenants to come back. Around the country, it's a little bit higher than New York. Going back to even 2020 or 2021, we saw continued increase. We thought we'd be back much earlier, but then we had, and we were pretty much as strong as that we were at the end of last year because of, all of the confidence in the market and, employees returning. And then, we had this variant happen and it kind of slowed down a little bit. Right now, we're seeing a tick up of about 2% a year or 2% a week in terms of employees returning. So Google has come back in April and they want their employees 3 days a week. Technology firms are doing that. Are also implementing, models to have them come back. I think we were at pre-pandemic levels in terms of occupancy about 80% or maybe 85%. So people aren't, because of traveling and, meetings and et cetera, we're never at 100%. And, people weren't coming in Fridays anyway. So if we can get people back 4 days a week, which we think is going to happen, in the near term, we'll bump up to 80% and, kind of be more closer to the norm. And it's all kind of contingent on vaccinations, which we, are seeing, and any new variants that come. So there's a lot of question marks out there in terms of that.
Yeah. And, I was speaking with a former student who is based out of the Tampa area, and they own and operate office properties down there. And one of the things that I didn't think about, because I would have thought that they would have had a lot more of the office tenants coming back in at a much higher percentage. And it was very much bifurcated. You had the local companies that were much more back to normal, and then the national companies that had more of a national policy about whether you have to go back or not. And I guess the idea was, if I work for a company that has a policy in New York that it's optional right now, or you can come in 2 days a week, and you're now in their Tampa office, they're not applying different standards for a national company. So fewer people were going in for that company because they had a policy nationally. But all the local companies that weren't national companies, most of the people were in. So it was an interesting bifurcation that I hadn't thought about until you kind of step back and look at the companies that are making a decision nationally. So
what also has been interesting is that even on the new construction, we are obviously, Climate Mobilization Act and being green and LEED certified buildings for not only, in having the better quality buildings, which is why they're doing so much better than Class B. It's the buildings construction hasn't changed that much. So we have seen that, there are still, the layouts of the floors are, there's open areas, obviously. There's more, meeting rooms, and, there's still the bullpens, et cetera. What we have seen is de-densification. So pre-pandemic, the square footage per employee was 125 feet. It's now bumped back up to where it was about 8 years ago to about 250 square feet per employee. So even if, we, get back to 70, 80%, that open space is still really necessary and considered to be very important for companies. There's always going to be work from home.
Yeah.
We think that, it's going to be based on demographics. And, if you're living in a small apartment in the city or New York, you want to be in the office. And, and a lot of companies are offering these incentives like free lunches, et cetera, to get them back. But, you want to have that diversity. And if you're an older, employee that's been, working there a while, maybe you don't want to come back. So, but the companies are they're not necessarily, they've been consolidating, and when they move to different locations, et cetera, creating different smaller spaces when they move, but more efficient, and planning for what it is going to look like when everybody is back.
Yeah, I think we talked about the idea of mentorship, and when you've been in the industry for 30 years, you don't necessarily need to be sitting next door to someone to kind of feed off of each other as much as someone who's very new in the industry. However, there's still a value even to the more seasoned. I'll use seasoned instead of old because I resemble the old comment. You still need to be, there's something about being down the hall from you where we grab a coffee and then just that chat about what we're hearing and what we're seeing, and maybe even as we're outside making an observation about, look how many people are in Bryant Park today having coffee. I mean, that's there's a lot of people out today. I mean, They must be they're either working from home and coming out to the park, or they're in their offices and coming out to the park to get some sun. So we're seeing those trends, and being near people to be able to kind of run those ideas off of each other, I think are very, very important. So,
collaboration is critical for a lot of industries. And obviously the real estate companies have been back from the past. I've been sitting at my desk, coming in every day since when so unlocked, in 2020. So, but, look, the traders have to be there. The brokerage, the financial services need to be there. And they, in order to do business, you need to, talk to people and see what's going on. I can't imagine, coming out of college and never meeting your boss, right? And it's particularly where you need that mentorship, like, law, et cetera, and you're training from, your senior, and, you want to be there. So I think it's more critical, for the millennials and the young, these generations that, coming out of college that need to really be in the office. And I think they want to be, for the most part. I'm interested to hear what everybody says about that.
It's a, I would say, intangible when the analyst or associate pops into your office and you get a call, and it's something that's going to be a learning opportunity, and you put the phone on speaker, and that younger professional gets to hear some insight that would not have happened if they were zoomed in and working remotely. And I don't know how you quantify that. It just is there. And whether it's 2 days, 3 days, 4 days a week, whatever the number is, it comes back every incremental day that you're, feeding off of each other and getting that exposure. I think there's a value to that.
And a lot of companies were there's obviously outsourcing, et cetera, but like Morgan Stanley, for example, they elected to keep their accounting and services downtown, and in Brookfield's building at One Liberty, but they're also there's also companies have moved their locations either out of Manhattan for their support services, or those people don't necessarily have to come in. Those employees don't have to come in, or at all, or as much. So it's going to be, I think the dynamics were changing anyway pre-pandemic, but this created, this whole, working from home, and has created a lot more flexibility that companies are willing to offer their employees, particularly because it's so competitive.
Yeah.
But if you look at, the reason why companies are in Manhattan and the reason why they have these office spaces and the reason why in 2020, the financial services were pulling back or not leasing space or buying buildings, you have yet, Google, who's expanded, and all of the tech companies were growing during that time and actually leasing space. And there were the major, there was a major industry thing to do. And the reason why they're here is because of all the, Ivy League schools and getting the best talent. This is the reason why Silicon Valley is here right now. And they've had the foresight to realize that. So it's all going to be, fundamentally based on how comfortable everybody is. But we're seeing increasing, we're back basically in terms of traffic and bridges and tunnels, where we were pre-pandemic. People walking on the street, restaurants are full. What you're seeing is, we're still, 15% behind on, subways and trains and, public transportation. But it's catching up and it's getting better.
Yeah. A couple of questions came in. I'm going to try to tie them together about office markets and locations and where you see the demand coming from for sectors. So maybe, outside of New York City, are we seeing an increase in demand with a relocation from the big gateway cities to these other secondary cities? It sounds like it when you watch the news, but then that's watching the news. You're in the deal. So what do we see?
Yeah. I mean, let's talk about the gateway cities, and we'll, in the Sunbelt areas, and like Austin is doing, they're all doing very well in terms of like attracting talent. Atlanta's doing well, Austin, Dallas, Charlotte. And the reason why is the younger employees want to be there for the lower cost of living, the lifestyle. Companies are also offering incentives to move there. And a lot of these cities they're seeing in migration. People want to be in New York because, they moved here because of opportunities. And, it's a financial hub of the U.S. and probably the world. So, but the jobs registered in some of these cities have exceeded, it was exceeded well over where they were pre-pandemic by 135, 150%. We track all that stuff at Newmark. But it has grown into these other primary, markets around the country.
Yeah. And that might be not just cost of living, but tax base, your kind of ability to do ease of doing business, starting a business. So there's a lot of things that could be driving that. Another question is really about on the quality side. So I know when I sit in the classroom at 42nd and I look across Bryant Park and I point to the 40, 39, 38th Street, and there's a lot of mid-block Class B buildings in those markets that probably had benefited from the demand to be in the city. And if some of those buildings don't make it, which probably some of them won't, where are you seeing a repositioning, a conversion, any direction that's going in?
There's talks about it. I mean, if you look at the, Times Square South markets, submarket, and, some of these garment buildings, and, that's kind of going away as rezoning and it has been taking place. Downtown, we saw a huge conversion to multifamily. 50 million square feet was converted. within the last 15 years or so, from buildings that were antiquated and just couldn't keep up with the rents for office. Okay,
Yes.
so the same thing is being talked about right now on some of the B buildings or side street buildings, where there's still have values have been impacted, 10 to 25%. And this is a completely different market than where values have held and cap rates have held, but and rents have held and they've even increased. But in the Class B market, they're still struggling. And I haven't seen, we haven't seen any residential conversions or other uses, but it's been talked about. And one thing that's very interesting is that, even though some of the B buildings are struggling, or many of them are, we haven't seen, they've been dropping rents. So they're down like 10% or so still, but we haven't seen any distress, like really any major distress. Like banks have been, very accommodating to work out and restructuring, or there's been recapitalizations taking place to allow those buildings to, not be underwater with their debtors. We have seen, there are some properties have been given back, like it's been in the press about 1740 Broadway, where Blackstone gave that back, but that was just really just they're based on their basis and the returns they could get in alternate, properties. Investment yields, et cetera, for multifamily and industrial. They said, well, I've got an empty building at 1740 Broadway, let's just, give it back into to the lender. But I can tell you right now, working with several developers, they're looking at it and it's going to create an opportunity for that building. So, but the distress market we just really haven't seen it. We expected it to happen, but we've come back to a point where I don't think we're going to really see much of it.
Yeah. I mean, I wonder, and it kind of touches on some of the other macro factors that we have to deal with now. If interest rates are going up and cost, including energy, is going up, insurance always seems to go up. And I don't know if we've really experienced the real estate tax increase that at some point there's been a drop in collections, and that's a big part of supporting the city budget. If these things go up in the face of a lower demand for the B buildings, is that possibly a pending shoe to drop with a lot of the kind of B quality buildings that from a financial perspective are not going to be able to kind of pay off where they are because it's going to cost more to run and the demand is not going to be there for the tenants to pay that the level of rent that they would need to pay.
Yeah, I mean, operating expenses are very high in Manhattan, and taxes. Look, in 2021, we saw the city, just like we saw at the beginning of the financial crisis, taxes assessments dropped. They dropped about 10 to 15% around the city to pretty much across the board. And now they've mostly recovered that. So the new assessments that have come out, they're back to where they were. Okay. Operating expenses, are also, have not dropped. They're still very expensive to run a building. So you have to have those rents to make sure that they, operate. But again, at the same time, if you're not able to run a building and you're in the red, you're going to have to, figure out where you're going to get your income from and how you're going to lease your buildings. So on an operational standpoint, you have to have modern, even on the big buildings, you have to have modern elevators. Most big buildings with any kind of vacancy have to renovate. They spend, somewhere like $25 a foot or $50 a foot renovating their lobbies, elevators, lighting, creating amenity spaces and meeting rooms, et cetera, in the properties to make them competitive so they can continue to operate as those properties.
And, when you think about the capital that you mentioned, nothing's more frustrating than working in a building where the elevator service is subpar and that you just wait and wait, and you have to let the next elevator go by because it's full. And obviously lately we haven't had that full problem, but when you've experienced that in the past. But on the capital side, the sustainability demands that are going to be there from capital, from tenants, from regulation, from the government oversight on, you need to have certain levels of efficiencies in your operations from an environmental perspective. Those capital items can be pretty expensive.
It's very expensive, and it's financeable because money has been cheap and interest rates have been low. And I want to talk a little bit about interest rates and what we're seeing in a minute. And what all the mortgage brokers and everybody's talking about for that. But Local Law 97, Climate Mobilization Act, has been taken very seriously, and we have set dates on these buildings to upgrade for emissions and utilities. Okay, so every building now has a rating. A, B, C, it's like D, it's like a restaurant, right? So in 2024, the fines will be implemented. And there's something now called PACE financing, where you can finance at a very inexpensive rate. A lot of lenders, are offering that more and more, but all companies are taking this very seriously and are addressing that, and actually have in-house staffing to deal with how are we going to deal with emissions, and and particularly where their utility costs are very high, like on trading floors. There are Class A buildings that have very high utility bills, and those are being downrated and could potentially see fines. So it's something we're addressing in our appraisals. We're increasing capital reserves and costs for those, but it's costing more and more to own an office building in the city.
Yeah, and that really could be something that, if your building is kind of on the precipice of hanging on or not, if those costs get put in on top of my operating expenses have gone up, I'm not able to get the rent levels that I need in order to continue to make those investments. I think that might be where there's a latent distress in some of those properties. It just hasn't shown up yet because they haven't gotten that final blow yet. But there's probably going to be some component of the market that's going to experience that aren't going to be able to afford those CapEx costs to bring the properties up to the standard that they need to be.
You're going to have to spend the capital, and it's becoming more and more expensive. But and we're going to see what happens. And on the return to the office, we think we're going to be back to 70-80% by these major corporations. At some point in this year. And when we do that, you're going to see more demand for these Class B buildings and those type of tenants and accounting firms and all of the service providers of this corporation. But we're very optimistic about it in terms of the demand out there and all of these things that I've talked about. Yeah. But I think I wanted to talk a little bit about interest rates because I know you put some slides up.
Yeah.
I think it's healthy. I think it's good. We have a lot of risks out there. We've got inflationary risks. Or are we going to see cap rates going to go up? And look, for a long time in the last decade, we've been in a low interest rate environment, and it's healthy for the financing market and for lenders and developers and creates that demand. but also at the same time, it's also on a long-term basis. We have the risk of going into a recession, and that's we've seen over the last 3 to 4 months. Inflation, that's to say, and so we want to. I think the Fed has offered increases in the rates. Those have been built into the cap rates and the transactions that we've seen. So we haven't seen rates necessarily go up. But if you look at lending, we were static for 2020, and there wasn't a lot for most of 2020, and there wasn't a lot of financing activity going on. It was just kind of taking care of properties and making sure that they were occupied, or making sure that they were meeting debt service, et cetera. At this in 2021, going back into like September, you could borrow money because of the demand for the debt market at 2.5%. It's now back, up 150 basis points or so. So rates have definitely been increasing, and and it's been without the Fed even touching the discount rate. It's been creeping up, but I think it's it's potentially that it could go up more. But I think there's just so much demand out there, so much capital that you talked about. It's going to create. You're still going to see the financings going on, and it'll bring down that risk for a potential recession, which some people are even talking about now.
Yeah, that the yield curve had been inverted. It looks like it flattened a little bit, but that the inflation and recession at the same time, stagflation. The two of us are mature enough to remember what that looks like when you're living through it, and it's not a pretty picture. But look, this is just another example of, we don't know how long. If you're projecting in your strategy for investments, are you going to say, I think we're going to have sustained 7% inflation for the next 4 years, and then it's going to back down? You have to have some view on it, because when you look at that red line, that it while it moves around, it hasn't seen that kind of spike that we're seeing now. So that doesn't mean that that's what it's going to be going forward. That just means what it is now. And that has to be part of your thinking to decide, what am I going to do with my capital then?
Yeah, inverted yield curves are not good. And, we look at the indicators like, interest rates on 10 and 2-year short-term versus long-term, rates. And, to see, 2 years being close to 10-year and even under is not good.
No.
So, and the Fed has to have the flexibility. Right now the discount rate is so low that it gives no flexibility to correct it. So that's what I mean about long term. So if you have, if you have the best tool for the government and the Fed to manipulate, the economy and keep it healthy, if that goes up in the long term, it's better for us all.
Yeah.
We just don't think it's going to, impact cap rates dramatically. We haven't seen any increase in, cap rates across the board. Cap rates for sales, et cetera. But the cap rates on residential and industrial, because of the demand and the flight to money into those sectors, has driven down the cap rates, while office cap rates have held. There's room in there to to maybe increase in some segments. We think office is probably going to be a little safer. We also track very closely spread to treasuries and We look at, which are, this is why real estate is so attractive right now. But, in office, if you're talking about a 3.5 cap rate or so for industrial or multifamily, and you're talking about a 4.5-5% for office for cap rates, it's very attractive. But it also, the flight to money into and all the dry powder into office, makes a lot of sense.
Yeah.
So there's a lot of indicators that we're looking at. Interest rates has played a very important part of this entire cycle over the last 2 years.
Yeah, and even just looking at that delta between treasuries and inflation, the when your nominal return on your money at a risk-free rate is negative by a lot, because your dollar is going to be worth that much less next year. That means people are going to have to take more risk just to get to the dollar being worth the same next year. Increase that risk premium so that they're treading water, and that might be the place where we see the distinction between cap rates broadly may not change that much, but the ones that are the riskier buildings are going to see that increase, while the other ones may not, or may even see a tightening with more capital chasing the better quality, the better market, the better location, the new shiny, best of the best in the market.
Yeah, and investors right now are looking at, and they have been looking at transactions with a lot of WALT, safety, and a lot of term credit. And that's where, the transactions we've seen, and, in these 4.5 cap rates, but on these sales, over $1,000 a foot. It's honestly the first time in my career that I've seen 2 office buildings trade on Park Avenue. They never sell. So you have 450 Park Avenue that's sold for $1,400 a foot, like a low 4 cap rate. And you have 320 Park Avenue, Mutual of America, who's recapped that. And that was a major transaction at the same price points. Yeah. 245 Park Avenue is now being marketed. So the better locations are where you want to be and where investors are looking.
Yeah.
For safety.
And the question is going to be that the buildings that probably are not going to command those kind of cap rates or prices per square foot, they're not trading now. Probably one reason might be I can't afford to sell it, because what I would get right now if I sold it versus what I owe on a loan per square foot on these properties, because of when I finance them, that's not going to pencil out very well for me. So that sale's not going to happen right now unless I'm forced to sell it.
Yeah, that's why you're not seeing a lot of retail transactions. You're not seeing, because of the rents declined in the city, 15 to 25%. And, but that was part of another correction that really needed to be happening.
Yeah.
Okay. And then you're looking at, you can still borrow money, for, 3.8 for 3, under sub 4%, but the LTVs, and the amount of equity that's been being put into these buildings is now like 50 to 65%.
Right.
So it's good. So you don't over lever, and that's where investors get into trouble. And thank God they've been working with a lot of the developers that have had their rents drop and have had leasing problems, and they're coming back, and it's just going to be it's going to take a little longer for the B market to recover and work this all out.
Yeah. So Doug, we're at the bottom of the hour, and I think we've gotten the most of the questions that I've seen show up in the chat. But let me just ask you, what's the thing that keeps you up at night in terms of real estate related, that is, that keeps you up at night with where the market is and, what may or may not happen. Sure.
I think, we've talked about a few of them with like interest rates. I think, we've seen, I think it was Deutsche Bank that's come out and said, or one of the lenders has come out and said, hey, we're worried about about a recession potentially happening next year. Those are some of the things, but I think the hybrid model and what that's going to look like, what's going to happen to B buildings, and how many employees are actually going to be back in their office and what that demand is going to look like. And, you can't push them back, the employees back too hard because they can go to another company and they're looking to look for lifestyle. So those are some of the concerns that, I have and we have in the industry. But at the same time, you're seeing a lot of positiveness, a lot of positive things that are, still creating a lot of demand for office. And that's good.
Yeah. And last point I would just add on top of that is people to get them back into the office, you have to feel safe about getting back. And, yesterday's tragedy on the subway is not a good thing to happen when we're trying to incentivize our employees, our office workers to get back into the office if they feel unsafe. So even little things like that, the headline risk of that doesn't help the percentage of key fob swipes to go upward.
Well, the more people, the more people are in, the city and their offices and, commuting, as that continues to increase, crime goes down. So that kind of goes away and corrects itself. Yeah. So, we have new, government, in the city. We've got, proactive, politicians now, and there's a lot of good things that are saying that is going to continue to get go away, and we're going to see things much better.
Yeah. So, well, Doug, as always, thank you very much. Earlier in the chat, we posted links to a couple of pieces that Doug shared that I think are very valuable to take a look at. And if anyone has any questions, you can reach out to me. We recorded this. It'll be available. And again, thank you, Doug, very much for your time today and your insight. And thank everyone for joining. So be safe and look forward to seeing everyone soon.